stocks retreat from their highest level since 2008 as Greece tries to avoid a messy default. And on a positive note, the New York Giants win the Super Bowl. I'm Alex Steele, and the Morning Call starts right now.
Good morning, I'm Scott Rudler, Chief Strategic Officer of T3Live.com.
And I'm Alex Steele with The Street, and together we bring you Morning Call. Happy Monday, everybody, especially if you're a Giants fan. I have to wonder if there's going to be light volume today on the stock exchange.
I think so. I know myself, I was out till late last night. I know a lot of guys are actually in Indianapolis, so today could be a lethargic, slow day. Congratulations to the Giants, classy operation. I'm a big Eli fan. Good stuff. I think across the board it was just a win for America, with advertising, with companies, with it getting off. I liked Madonna, a little whatever. I like Madonna. A guy saying that. Anyway.
All right, let's get to some futures though.
Yes.
I'll save you from that. So futures are pointing lower, however, because Greece could not come up with some kind of austerity deal within Parliament that then can secure a bailout package. Is that what's really leading futures lower, or were we just overbought and we're just sort of tiring out here a little bit?
I think if people were really worried about Greece, it would be down 12 to 18 handles, but to be down 5 to 7 handles after getting a nice jobs report, a little bit of a technical extension on Friday, you put that with a little bit of the Greece news. If it was done, maybe it would be up 4 or 5 handles. It's just par for the course,
right?
Meaning that you have to just keep managing your positions, stay with stocks, watch for composure changes and whatnot. And this down open, I think, if met with buying, will be the same as we've seen for the last few weeks.
So looking at the chart then, what kind of level are you looking to? Hopefully we'll get some big buyers in.
All right, so let's take a quick look at the S&P. I want to show you the same composure that we've seen since the start of the year. So you take a look here. This is the longer term gradual uptrend that we've been in since the October 4th low. This was that December 20th gap and go that when, was pretty accelerated. Last week we had some sideways action to absorb this huge move, but I want to show you a closer look here of what has been going on every single time we've seen a new level. Okay, this was the first time we gapped up, just say in the end of December, took 4 or 5 days to absorb it. And then we gapped up again that day, and then you had a down move that was met with buying in the end of the day, and then we continued. So fast forward, last week, couldn't break below the floor here that we had about 1303, 1308, so we continued. So this was Friday's day, and now if you look at that gap here in the spiders, 133.77 is Friday's low. Then you have the January high here of 133.40. So I think big support will be between 133.40 to 133.75, and if the market is in the same typical composure here, it holds, absorbs it, goes sideways, and we continue just to rotate through the sectors.
So if we hold that, does that mean that you're a buyer into the dip? And then if we break below it, are you a seller or are you just holding?
I think you watched the action. Like today, if we're down 30 to 40 points in the Dow, or 12 to 15 points in NASDAQ, that's fine. What I did is I trimmed some longs into Friday's gap up, or into Friday's extension, and I put on some hedges. So in this down open, what I'll do is I'll cover some of my shorts in the diamonds, maybe sell a little VIX, and see if some of the stocks I'm holding is showing relative strength, so then I could add to it for cash flow. And that's how I'm trying to manage this move that we've seen that's been about 30 some odd sessions old, to stay with it. Hold longs, manage a hedge, and then just play for cash flow breakouts depending on the setup.
And I just want to ask you a quick question on the fallout from the positive jobs number. I've read a lot of reports over the weekend that says perhaps that might signal definitely no QE from the Fed. The interest rate debate is still sort of up in the air among some analysts, but the threshold for QE3 is very low, but it doesn't look like they're going to do it. Is that a potential headwind for stocks as a trader?
It could be. It's that whole thing. Okay, if we get the data's too good, if the economy starts, really going, we'll get no more support from the Fed. So can the economy actually hold itself higher? So we need to see what kind of composure. Like today, if we were down 140 points in the Dow, people are like, what do you mean? What happened? Jobs number was good. Earnings reports were great. Maybe someone knows something that the Fed has said, off the gas, and they're a little worried about that. So until we see that type of day, we can't speculate too far on, a composure change.
And I know the Deutsche Bank is very much expecting that, like rates being raised around 2013. Anyway, so let's check the temperature of some ETFs to see where the opportunities may be, what levels you need to be really watching out for. Scott, I want to start with the XLI, closed right near those 52-week highs. But then this morning we heard the IMF said that China could grow 8.2% this year. But if Europe goes into a deep recession, we're looking at perhaps shaving up to 4 full percentage points off of Chinese growth. That's enormous. And that could really hurt the sector. Flip it. if they wind up pumping more money into the system to avoid that kind of growth, it could be good for the sector. Well, how are you taking it and what level are you watching?
Okay, well, I just looked at this chart in the sector. It's been leading the market also. It's been, in tune with the S&P. I haven't been focusing here, but if you look at the chart, you will see that overall it's pretty healthy. The industrials have been moving up. There's been a lot of really nice opportunity there. This was the same type of thing as the S&P when it had that descending channel, broke to the upside. This is when you wanted to be in a lot of it. Then it accelerated higher, big gap up into some resistance. I don't see any problems here yet. Same type of scenario here. You have a nice gap from Friday. You want to see how much of that gap holds. So I would watch Friday's low, which I believe is around 36.99, and just want to see which sectors hold the majority of their gaps, and that's where my attention will be this week.
And then XLY, also want to hit on that because closed Friday at 52-week highs. It's sort of continuing the jobs euphoria here, not to mention that average hourly earnings rose 0.2% in January, and Deutsche Bank is actually predicting a 0.7% increase in personal income for January. That would be great if they started to spend more.
Yeah, and this group has been reflecting that. And stocks within this group is reflecting. And if you look here at the ETF, it looks very healthy. Had a nice breakout above this area, just like the market, above this 39. Had a nice consolidation, went sideways to absorb the move. Friday's move was clean, and it broke and closed on the highs. So this, to me, still looks good. The consumer has been in the game. Every time people count out the consumer, count out the spending, the stocks still perform, and the companies keep coming out with data to support it. So until that changes also, this still looks healthy.
And OIHs, how healthy do they look? We are seeing oil prices come off today.
OIH it's been more of a slower, more methodical move. Back in December, we talked about, but this was always a bottom feeder type of situation. Consumer, like retail was leading last year. Some industrials perked up earlier. The OIHs was that inverted head and shoulders pattern, which was a slow accumulation type of group. So if you look here at the chart, you will see that, here's that left shoulder, the head, the right shoulder. Let me get this out of the way. Here is the tier 1 accumulate. Here was your tier 2 when it broke this downtrend. And then this was your room from breaking the downtrend all the way up to the new resistance. So on Friday, I did sell a little bit. I'm still long OIHs, and I still think you have room to this neckline, but this is very slow, methodical. It's not near the old highs like you just saw with the consumer staples or the industrials. So this one's not going to move as fast. The 200-day will be resistance, but I do like stocks in that group. I think you could stay there for an investor, and just take certain trades because, like, I tried to play Schlumberger.
Right, I was going to say.
And it broke out, but it was not a great, powerful move like you're seeing in some other sectors. But not everyone's looking for that type of quick, frisky action.
And really quickly, we have three more I just want to highlight. Let's go to the housing index, the XHB. We have good backlogs, good new orders from the home builders that reported over the last few weeks. But then Weyerhaeuser said something interesting on Friday, that expecting a loss actually in the first quarter from single-family home building operations, which was odd because it seemed very different from what the home builders had been saying. So I wanted to see how this sector was holding up.
Well, these home building stocks have been unbelievable. They've led the market. A lot of people thought perhaps, we can get a January effect type bounce, small little bounce. This has been far from it. You look here, this has been actually leading the market. Right? Like typically you get like a January effect move where, you bounce to here and you never get through resistance. Like this, I remember talking with Jim about it, sending him this sector, and I said above this area, you're going to see a run, and it continues to run. It's above all moving averages. It closed near the highs of the day, on Friday. So this looks healthy. And sometimes what you see in the market is, when the stock market turns, they say, it's a 6 to 9 month leading indicator for the economy. So if this group is now a leading indicator for housing getting better, so if housing gets better in the next 6 to 18 months and we get better data, you're going to see a better economy. You're going to see Americans feeling healthier. And, you could see the overall stock market really continuing. So you don't want to fight the trend here in this market because there's just way too much opportunity.
Right. And then wrapping it up here, let's go to the banks, XLF, to see how well they have been holding up here. Been really strong so far. Yeah,
these banks have been great. They just say they changed gears a little bit. Remember when J.P. Morgan reported? That was after the first move. But then once Goldman Sachs came out and they bought that, these have been buy on pull-ins each and every time, and even play some breakouts. You look at the XLF, you'll see, this was the move off of, or just say this is when it broke its downtrend. And we talked about the few different uptrends here. This was the gradual one, and this was the more accelerated one. And for the banks to be in an accelerated uptrend, we haven't seen that in a while. So you never want to really chase. banks, but there is some room in these XLF to get to 15, 15 and a half, which would be the summer highs. And if you look at some stocks like Goldman Sachs, that's broke above the October high. You have Wells Fargo that's already well above resistance, and then.
But these might be more trades than long-term investments, right? Because if we do see low rates for an extended period of time, they're just going to have such a hard time making money.
Right, but then there's also talk how rates can go up sooner than we thought if we start getting better data, and higher rates are better for the banks. There's more business for them to do. It was definitely, as you extend, it's a little bit more of a trader's game because you could always get that pullback. But I think investors that bought into December and the January effect got a little bit more bang for the buck because they didn't expect to have this type of move, and they should stay with it until the composure changes.
All right, we have a lot more for you, especially stocks that had bad earnings and now are doing really well. So stay with us.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
All right, here we go. We're going to go with stocks that had negative earnings that now are stockers doing really well. Oracle reported in December. That was their Q2 fiscal earnings. They're not going to report until March for their third quarter. But we did learn a lot, like guiding revenue growth of 1 to 5%, which is on the low end. But the stock has been making up gains after that big sell-off.
Well, that goes with the fact, know your time horizon and have different type of trading strategies. I remember that day, Oracle holders were upset. I said, if you're not involved in this mess, there's an opportunity. So you look right here, two ways to play this. One, you could have bought the dip versus that August low, which we did talk about, 25 being big support. And then sometimes after a big down move, you get the gap fill. This one was very, very slow. But if you traded it for a gap fill, you got a little bit more than you bargained for. So if you didn't take stock into the earnings, you're able to buy versus support and get a decent trade in the gap. And we're starting to see this type of trend for very profitable cash flow.
And because this is one that hasn't reported yet, you have to be a little careful, though.
Right, because this was like a last quarter trade that gave you indication that this quarter, or that you could stay with it, which we've seen with some other stocks in the last week or so.
Okay, and then so let's go to Google, though, because that miss, the big one was the cost per click, was the big drag here. And if you look at, say, the U.S. online display ad market, Facebook has 28% of market share, and Google has like 5%. So you have to wonder, is Google just not doing something right? But the stock has sort of, again, made up for it.
Yes, like there's different type of time frames. Investors were in the penalty box if they just stayed the course. Active managers or active traders who bought in front of the 200-day and then went for that Q trade into the gap, they're very successful right here. So look at Google. Here's what I remember talking about, this 200-day many times. So here is if you didn't take it into the earnings, you had a huge gap down. If you were patient, you waited to this area. You got in for the 200-day, you brought your cost average down. And if you were a trader looking for this gap type fill, you bought it above 591, it closed 595 so far, decent cash flow trade, and I think this can get above 600 and fill even more of this gap. So this gap fill trade after bad earnings with a little bit of time is working for traders.
Still your favorite stock for 2012?
We'll see. It's different. You had to switch gears. They missed on earnings. The trade became different where we're only in February and we still have 10 months left. I do think the highs of the year are not in.
All right, Amazon guided lower as well after its quarter. And I was speaking with Jim Cramer on this, and he was basically like, I just don't know enough yet. Like, there were just a lot of questions for me that they didn't answer in the quarter. That's what he said. But the stock has been performing well, so I wonder if a lot of investors feel like those questions have been answered.
I just think...
or a good trading vehicle.
Both. I think that people are trying to give it a pass. Every time they've missed on earnings, it's because they're expanding all their businesses for future earnings and a future, revenue. So if you look here, though, we talked 170 to 173 as big support. And if you bought on that support, kind of like we saw with Oracle at 25 or Google by 560, you got rewarded. So take a look here. This was at 170. This was that support from December, and it held higher. This was after the earnings. So if you bought 170, 173, you got paid. And then look at this, going into the gap. This was obviously a lot friskier than an Oracle, so to speak, but the beta is much higher. If you traded into the gap above 180, it closed at 187, almost closing this whole gap. Last time it came lower, it gave you a very similar gap fill type trade, but then once it filled the gap, it turned tail. So make sure that if just say it goes to 190 and stalls, it might have just been a nice trade, not a macro move. So pay attention to these gap fill type trades for cash flow or macro moves.
And let's go to Acme Packet. Reported on Thursday, and despite earnings estimates, it rallied big time on big volume on Friday, up over 9%.
Well, this goes to the fact where if you can't sell them off on bad earnings, that means they're washed out. We remember X.
Or is that short covering or something? Or do you really think it was fundamental?
I don't think it could have been both. It could have been like, okay, now the quarter's out of the way, and all the bad news is done. So, but look where it was. It was at the bottom of this overall range. This stock has moved, from as high as 70 all the way down to the low 30s. So maybe it was priced in. But anyway, the action told you it was. A lot of my traders were looking at it on the open. Once it cleared this 31, short said, uh-oh, they can't sell down on bad earnings. Look at this downtrend we're breaking through. We better cover. So at this point, I think you stay with this one, and you could add above Friday's high, and it probably has room to about 40 to 45. This stock looks like it's washed out and can go higher.
And want to wrap up this segment with SanDisk. It's a little bit of a different story because it beat on EPS, beat on revenue, but didn't beat as much as people were expecting. They were expecting the revenue growth of 12, 14% that they had seen in the last 2 quarters. I mean, come on. I mean, they don't grow as much, and now the stock is actually being rewarded.
Well, it's consolidating. The report wasn't good enough for it to be frisky to go to all-time highs. So if you look here, people were expecting a good report. I also was long on the options.
It was still a good report. It just wasn't like the stellar report.
You need a stellar report to make new highs, historic highs. And right here, this big area of consolidation was waiting for a stellar report, which it wasn't. So that's why it opened up at the bottom end. But now you could get a nice little gap fill type trade. Remember, we just showed you with Oracle. I don't think it's going to be like an Amazon and so big, but if it gets above this 40, what is this? 49-ish, or not even 49, 48. You could see a move to fill the gap for a trade. And if you're an investor and said, you know what, I think next quarter is going to be SanDisk quarter, they just didn't have enough room, you bought in this lower end of the range, near the 200-day, kind of like a Google, and then your cost average is better, and then maybe next quarter it finally gets going and goes above it. But the only way you're going to hold that is if you're a macro investor, and the only way you're going to do that is if you truly know your time horizon. So
that's
at
like
this
the lesson
point,
of the day. Time horizon. All right, let's go to some 5 stocks. You might be able to make some quick cash today. Apple at new 52-week highs again. What are you doing today?
I'm still long Apple. If it gets above 460, I'll add for cash flow. But you have to tier in and tier out of this one. It's been a good one since earnings, but it still hasn't had that blow-off move that Apple needs to have before I think you can call a short-term top.
And then what about LinkedIn? I know you were kind of playing that last week based on the Facebook news.
Yeah, LinkedIn was a good buy around 77. I think LinkedIn you could add to it if it gets and stays above 80, 50 to 81. I think there's room to about 90 on this one.
And was Pandora the same kind of thing?
Pandora, I want to show you the chart because this one's nice and tight. Looks very similar to me that I saw with Groupon before it went. Here's a high. Here's another high. It's holding in here, kind of changed this trend. I think if it breaks above this 14, you're going to have a move to 16. If you remember last week, I showed you Groupon. Groupon was an unbelievable move, had a nice downtrend where we were talking about buying it around 2050, went right to the resistance. So let's see if this Pandora could play some catch up here. I'm in tier 1, and I'm going to add through about 14 if I see some real volume.
And Altera Group, a semi, we don't normally talk about it that much.
Let me take a look, because since I don't talk about it, I probably don't trade it that much. But it has
it was on our list, so someone liked it.
Because it has a nice setup, a nice setup right here. If this gets above this 41, okay, it could move to about 44, 45. Nice, 2 water range bars here. Holding higher. I think this looks good for higher prices above 41. I think you make some cash flow.
And then dry ship, we had a historic 52-week low on Thursday, and then it was up over 11% on Friday. Is there more bottom feeder trade going on here?
That's what I think this is, because this group fundamentally still has work to do. But at the tail end of every rally, these shippers come alive. So if you could time it right, you can make money. And all of a sudden,
so the end of the rally, they come alive?
Well, the tail end of a move, traders and investors need something to do. So this could signify a pause in the market soon. It used to happen that the most speculative stocks go at the end of a rally, because traders are just, rotating through and they have money to work and they just did well. So here on dries is just, it's one of those groups that has been out of favor and people are like, oh, let me take a look at the shippers. So I looked here on Friday, I saw this big volume spike come in. You look at this downtrend all the way up from 450 all the way down to here. So I did buy some. I think in like the 235 area. I'll show you real quickly here, on volume, so you can see what I saw there. Look at the volume that came in here on Friday. So somebody's buying it for something. So it looks like to me as if this thing could hit 3 or this moving average at some point in the next, who knows how long it takes, but that's a nice percentage gain and you could use $2 as your stop.
But really good to know that that's where kind of traders go to make extra cash when maybe the rally overall has run out of momentum, which speaks to your time horizon and manage those positions and, a little cautious.
There you go.
All right, good stuff. Thanks so much, everybody. Happy Monday. I'm Alex Steele from The Street.